Awesome. So we're going to talk a little bit about why just understanding returns is important kind of at the high level stage. So this isn't, in-depth kind of tax analysis. This is more for you guys, Sean, Leah, Ashton, Dylan knows his stuff, but just some things that kind of stand out from our process. And the feedback that we've gotten is that, in some cases we're saying, here's your return. We're all done. Let us know what you think. Let's get this filed. And the feedback we got is clients kind of want to understand a little more about what's going on financially and, like what they should do based on their return, which is an operational challenge, but I think it starts with being able to really get a grasp of, what everybody's looking at. So that's part of the why of getting into the weeds here a little bit and just being able to, in 60 seconds, ideally, once you get good at this, within 60 seconds, you'll be able to kind of know what business they're in, what they have going on, and if there's any hiccups that are going to kind of feed into our scope. So just so everyone has a sense, about 25% of the returns we file are going to be corporate returns. Those include partnerships, S corps, and C corps. And the reason, it's actually a big absolute number, but the reason it's so low is because we have so many Schedule C filers. We're really like an 80-20 when it comes to, businesses being sole props versus a corporate return. And then a lot of the times what we realize this year is, a client reads something online, they set up their entity and they hand it over to us. They say, here you go, get it done. And it's their first year. They haven't connected their banks. In some cases, you have couples that are filing as partnerships where a single member LLC would do just fine. So there are also instances where kind of miseducation brings them into complexity when they don't need it. So we want to be able to very quickly, in the engagement process, tell the client, number one, hey, this is what you're looking at in terms of what we're going to file, right? So if we're going to file a partnership return, that's a separate tax return, as you guys know. And we have to file your individual. You're going to get a K-1, right? I think Sean, Ashton, you guys are both pretty good at calling that out on the front end. And being able to give the client an option to change that in year one is super important. So other things that we just want to touch on here is looking at the last year return from the get-go, right? So we want to understand year over year what's going on. So if we get a partnership return, at some point the initial tax pro is going to go in and say, wait a minute, was this really messed up? Was this filed right? Do we need to even talk about amending? And Mike, I thought right here I could throw you a softball, and I know we have a recent situation with a client where we actually are now amending the return. So maybe just to bring this to life, would you be able to share that example?
Yeah, sure. So I think we had two recently that we needed to amend. One was somebody, and usually with the corps, I think they were both TurboTax returns. So you kind of almost know when there's a corporate tax return where they did it using TurboTax or some sort of homemade software. You almost know that there's going to be a mistake there. And the big one was, it was a decent sized corp, and they did it themselves and everything looked pretty good. But then when I was going through the California return, I saw that they did a apportionment to the state. So even though they were in the state of California, they said that only 10% of their income was from the state, and they had a big loss. They had like $1 million loss. So basically, if we didn't catch that, they would have lost $900,000 in NOL carry forward. So, it was a big number.
Very good. Yeah. And Sean, if you're scratching your head, how could I have caught that? I don't think you need to, but I think you could check, Sean, on page 1 or 2. I think it's the first page of the corporate return. Who signed it? Was it a previous, preparer? Was it another firm? or was it, self-prepared? So just kind of things to catch. But I think it's important that we understand if they prepared it themselves, because as we found, it's usually easy pickings.
Wait, you want me to look at the return, the previous year return, to see who prepared it?
Ideally, you'd be able to, if they were willing to share the return, you'd be able to engage at that level. Like, say you're doing a screen share. I'm not saying you need to review every return. The idea here is that you can skill up a little bit, can have some tools, questions asked, and I think kind of the punchline here is, hey, did you file your own corporate return? That's usually going to have issues there that are going to get caught, in which in this case led to an amended return. So just think.
Gotcha. Yeah, I got you.
Thank you. So I'll quickly touch on just some kind of engagement points here. So from an onboarding perspective, one thing that happened a few times is we brought on a client who had multiple entities, multiple types of returns, and they all got somehow lost in translation. So we have a pretty comprehensive engagement letter, meaning you can sign a business engagement letter, and it covers, in some cases, it covers two businesses. In some cases, it covers the business and the personal. In some cases, it covers the business only. So we definitely want to tighten that up from a sales to service standpoint. So what we're going to do going forward is we're going to need to have a separate Asana task for partnership and individual. And if you are working on a return where you, sorry, I got distracted by someone joining the meeting. If you get a return where you have an individual and you see that they are asking us to prepare a K1, you just want to make sure. John, we're getting feedback. I think you're in twice. You can just mute. Thank you.
Sorry, my bad.
It's all good. So, yeah, point being is that we need to be able to tell right off the bat that we're doing both. One, we do customized engagements in some cases where I just got a phone with a client where we did a Schedule C only. And part of kind of our feedback process as we come out of this, Leah, Dylan, and I have time tomorrow to talk about, do we need to have different types of engagement letters so that when we do the billing at the end, or when we're looking at the Asana tasks, Dylan can quickly check what are we scoped out to do. So understanding the returns from the prior year, even at a sales perspective, Sean and Ashton, knowing what returns were filed. Okay, you filed two 1065s, one 1120S. You need your personal 1040, and understanding how those play together are going to be really important. But also important that as a tax advisor, when you jump onto a client, that if you catch that they have K1s coming in and they're saying, hey, aren't you guys going to do that K1? That you go back to Asana and are able to check, do we have that engaged? And if not, we need to kind of elevate that quickly. So with that said, I'm just going to breeze through, the Schedule C. So oftentimes when someone says, I have a business but not an entity, it really means that they're a sole proprietor and filing the Schedule C. It's very important that as a tax advisor that we're aware whether they filed the business in prior years. There were a few returns this year where I got a draft and I looked in the client portal and there weren't previous returns, and the client was difficult about it. They were saying, I can't find it. My previous CPA won't send it over to me. And we try to be accommodating and say, okay, well, let me see what I can do. Well, what we're going to miss are a lot of the clues that we get from the previous year. Sometimes there's net operating losses that carry over, and that's going to be very common from a capital gains standpoint. So that we can only tell from the prior return. So we do not complete draft returns until we have both. In worst case scenario, we will make the client pull their own transcripts so we can see what was filed or not. And based on that, there are a few things you'll be able to check, especially when it comes to the Airbnb clients where you have the option of a Schedule C versus Schedule E. If there's history where we filed it a certain way, we don't want to switch the form that we file on just willy-nilly. There's got to be a conversation there, right? So these are some of the issue spotting things that we want tax advisors to pick up really quickly and elevate. Other things to be mindful of is, Mike, you had a really good point on finding kind of big losses the year before. And I think that happened on a few clients. I'm curious if you can kind of touch on that point. When you're looking at a tax return, you see a big loss the prior year. What comes to mind? What's your process in terms of figuring out what to do from there?
Yeah, so usually the reason I brought this up was because sometimes you see on a tax return where, maybe somebody's going to owe a big tax bill and they might not have the most honest tax preparer. And what happens in those situations is sometimes you'll see a major loss on the 1040, and then you could kind of flip in and you'll look at the Schedule C and see that, maybe they had supplies of $15,000, office expense of $10,000, advertising, and just all these crazy numbers. And then there's no income on that form. And usually when you see those, it's a little bit of a mess just because, somebody wanted to generate a refund and just put together a bogus loss there. And obviously it makes it tough conversation when we're, it's a tough conversation because they aren't going to get good numbers. So when I look at it, I usually always know that that's going to be a more interesting conversation than most, just because we're going to have different numbers than the prior year.
Yeah, and you mentioned something interesting. When you see large round numbers, I mean, how do you kind of react to those? I mean, do those kind of stand out?
Obviously the round numbers, somebody's just estimating it. And then usually too, if you see that they gave certain expenses the prior year and they're given the exact same ones this year, those are all things that are kind of red flags that maybe it's a mess or they're not doing the best job of personal bookkeeping.
Yeah, absolutely. I mean, I'll say that the thing that, been through 2 sole prop audits, Schedule C audits, and when you have commingled accounts, they ask for your personal and your business. Actually, I was actually told by one agent that anytime you file a Schedule C and it's not a separated return, even if it's an LLC, they'll ask for personal and business anyway. I haven't checked that with the with procedures, but the perspective was interesting in that they're going to want to see how things add up line by line. And, would it ever be the case that we'd get to around 10,000 number? Very unlikely. So yeah, those estimates do stand out even on a reviewed basis. And especially if we see these big losses, one thing to be mindful of is I spoke to this IRS agent and he was saying, hey, we need to wrap this up because I just got orders from up top that I need to audit in this area all of these preparers that are filing big Schedule C losses because we think a lot of them are bogus. So there's a concerted effort at the IRS level to find these big loss bogus, refund generators. And, I think that because of the business that we're in, you have a lot of folks that are running losses from real estate. We need to be aware of that. And we need to be diligent as advisors that we can always, sit across the table. Actually, audits might change to be all Zoom, but, you sit across from somebody virtually or physically who's reviewing stuff and you can say, look, these are reasonable numbers that I confirmed with the client. So when you see those types of things, what Mike's highlighting, what I'm hearing is we need to adjust expectations, right? All right, we may have just kind of gone broad brushstrokes before. This time we need to get a little more clear on what your numbers are. And Sean, I'll actually like to ask you, because I think the number one thing I hear once prospects cross the client border is they say, hey, just so you know, I don't have all my receipts. So Sean, I'm curious if you hear a lot about the accounting items and how do I work with you guys? And then what do you tell them? You just tell them like, yeah, just make it up, right? I'm being a little facetious, but seriously, I mean, what's the conversation like? I think what's the conversation like on accounting and receipts and what they need to be doing before they come in?
Yeah, I mean, I normally when people ask if they need to keep receipts, I tell them that they should at least you don't have to keep the receipt itself, but like some sort of record of it. Excuse me. And then the biggest thing is just having some sort of like expense tracking software, like QuickBooks or Wave or Xero or something like that. And then I think QuickBooks does have like a receipt function, right? Like you can upload receipts on a QuickBooks.
Yeah.
Is that right? Okay. Yeah. Cool. So that's what I've been telling people as well, that they can put their receipts on QuickBooks, so they don't have to keep like a physical copy of it. They can just put everything there, and then they can throw the actual receipt away.
Yeah. No, I think that's definitely the direction we want to move. Folks that don't have it, that just kind of knowing what we know. We have an onboarding sheet specifically because, at least on the Schedule C side, a vast majority do not keep reconciled books. So I think, this year there was a footnote that we included every time we shared a draft and somebody didn't have QuickBooks. We said, we assume that you have the proper documentation and records on hand to take the deductions that we're taking. Going forward, we recommend that you use some kind of accounting system. So I think in practice, as we kind of continue to work with the same clients, we need to revisit that, right? So going back to the initial why we want to, get into these types of things is that we want to be able to give clients advice, good kind of tips on what they should be doing after the tax return. And I definitely think that the accounting piece, if you see a really, really kind of bunch of round numbers on the prior year, and even in the current year, if on the onboarding sheet they're giving us 10,000, 1,000 miles driven, right? I know Dylan and I always kind of, I feel like Dylan rolls his eyes every time I'm like, what's this number, Right, Dylan? What's that?
Said only a little.
Only a little. Yeah, and we're certainly limited in terms of, what we say in email. So I certainly don't want people saying like, hey, this number looks made up in email. Please pick a number that doesn't look so even. So part of this is, getting on the phone and issue spotting with the client, I think is super, super important. Just a quick flow diagram, and, anyone who's looked at a return kind of knows this. This is more for Sean, Ashton, you guys can begin to impress or educate. And most of you know how this works, right? But you've got an intake or P&L. We file that on a Schedule C, right? That's the profit and loss equivalent in the tax return. And then there's a flow to it. So it goes into the Schedule 1, line 9, then on the 1040, line 7A. Why am I sharing this with you guys? Because I want you to be able to, when you look at a tax return, for you to be able to say, this, or even if you're asking, Sean, like if you're on the phone with the lead, like, hey, do you have your tax return in front of you? Great. Like they say, I don't know if I filed my Schedule C. You could tell them like, hey, go look at your tax return and Control F Schedule C. Or you could say, hey, like pull up Form 1040. And this is, excuse me, this is where it ultimately shows up. Actually, do you have anything on your line 7A? That's where the Schedule C, the business income, will live. The Schedule E will also show up there, but this tells you line 7A. If you want to seem real smart, Sean, just say, what was on line 7A of your 1040 last year? And you're basically asking them what they filed as income, but And it could also include different numbers, but it'll get you on the right path to kind of understanding what to have going on. The way to find out what all rolls in there, going back to the graph, right, is the Schedule 1. You might say it's too much detail, but no, it's important because what shows up on line 7A is a blend of potentially different businesses. And where you will see that, and we'll come back to this on the partnership one, is you'll see on Schedule 1 now, it says business income or loss, line 3. So based on what shows up here, this is coming from line 31 on the Schedule C. It's going to show up on Schedule 1. So I think we need to update that. So it should say Schedule 1, line 3. It sounds about right. So now I'm going to jump into the partnership ones. And again, I think we just want to understand the flow. And if you compare it to the previous flow, right, this is one tax return right here on the Schedule C. So the Schedule C is all in the same individual tax return, one tax return. Not the case with partnerships and S corps. And I think this is really important for you guys when clients ask for a K1, or they ask for the partnership, or they're saying I'm waiting on a K1. Understand this is basic stuff, but it's super important to memorize. Is that the partnership or S corporation return is going to be its own return, and the 1065 or 8825, it's a rental. It's still on a 1065. Is going to spit out a K1 for each partner. So as many partners there are, there will be an equal amount of K1s, and then those K1s get filed onto the Schedule E. They go on Schedule 1 again, then it shows up on line 1040. So this should look familiar. Again, the big point here is that there's an entire return to deal with before we even get there. And you might say, well, wait a minute. Couldn't we just do a Schedule C, and wouldn't that simplify it? There are nuances there, but I think it is very true to say that if you have the same business, you would have a more simple tax return. And sometimes people don't need complexity. Some people feel like they do. Oftentimes, you do not. So let me just pause there. Mike, do you have anything to add up to this point on partnerships and individual returns?
No, I don't think so. I mean, basically, just when you look at that form, you'll be able to see. And then if you look at it too, I think maybe, is that your next slide, Miguel?
Yeah. Which one?
I was just going to say you could see too, you'll see the name, but then you'll also see in that column B, you'll see if it's an S corp or a partnership based off of what's, well, you have it circled there in red. So I guess I jumped ahead.
No, that's perfect. So going back to this, and again, like, when would you need this, right? I think sometimes people are just looking at their individual return, Sean, when you're kind of trying to price this out. You could easily, if they say, I don't know if it's a S corp or partnership. This is kind of a neat trick, right? Can you go to your Schedule E page 2? You say yes. As Mike said, hey, what's in column B? What do you see there, right? P would be a partnership, obviously. S would be an S corporation, and you'll have kind of other information. But this information, this 37, is what flows through back to the Schedule 1. So again, this is going to look familiar, right? The C goes on line 3. The S and the partnership, as well as rentals on Schedule E, will all go on line 5. So again, if you want to see what's all rolled up into line 5, you go to what form, Sean Farrell? I'm just kidding. I'll tell you, Sean. I will test you later, though. You go to the Schedule E. So this would have, if
I think it's Schedule E.
That's half right, Sean. It's Schedule E page 2.
Oh, I was going to follow up with that, but you interrupted, so I didn't get the opportunity.
Very
Schedule E
good,
page
Sean.
2. Yeah.
Always,
Yeah.
always on top of it. I appreciate it. So
Yep.
when I ask you about this 10 days from now, you're going to nail it. I love it.
Schedule E page 2.
Yep. 10 days from now, I'm setting a reminder on my phone. Do not.
You do it. Set that reminder. Don't forget.
Yeah, absolutely. But no, seriously, Sean, I mean, I think Sean, or kind of, if we're picking up a new client for the first time, and you're a tax advisor and you go to this and you see multiple entities here, and, we look back and we say, in Asana, it shows up as a simple tax return. And Leah, that's something that we're going to have to kind of figure out is the nomenclature in Asana should say, hey, this is a basic return. And if you see basic and you see like 5K1s, we gotta price that out. So scoping is super important. There's kind of things we need to check. It's going to take more time, and usually, somebody with a lot of K1s is used to, complexity is not going to be hung up on, um, you know, getting the scope right. So back to that. The Schedule 1 shows up on line 5. Schedule C shows up on what line, Sean Farrell? I'm kidding. It's right here, Schedule 3. Don't even say it. So the schedule, so again, it's the same one. So let's see. Oh no, I got this in here a few times. Well, this slide is in here 3 times to really make that point. And then sometimes you will see line 5, line 3 populated. And that's when they've got multiple businesses that we need to kind of look at. Also important from an information request standpoint. I know, Dylan, we rely on the client intake. But again, if you have an intake that doesn't say they're waiting for any K1s, but you go to Schedule E, page 2, and you see something there, that's kind of a moment for pause to confirm with the client. So very good. So I think with that, I had kind of some other issue spotting items that I spoke with Mike about. I wanted him to kind of touch on that. The only one I added, Mike, to our list was, if we do have the partnership return and you see that there are multiple partners in a fund, for example, we do need to confirm every year, and you can do this with QuickBooks, but I like to confirm with clients every year that the capital contributions have not changed. It is sometimes the case that they do, and ownership percentages will change kind of throughout the year. Partners will get bought out. It's a good confirmation question to ask. Again, Sean, I think it's something to kind of put in your wheelhouse. How many partners do you have? What are the ownership splits? And have the capital contributions or profit and loss allocations changed from the prior year? That's going to be a really good question, and it's going to get them talking about their business and what they have going, right? So with that, yeah, Mike, you had some really good bits on what you look at, and just kind of top level partnership S corps. We've kind of brought them in together as the same things. There are some distinctions, so feel free to make those distinctions, and if we're oversimplifying by combining, please call that out. So with that, I'll hand it over to you, sir.
Yeah, sure. So basically, usually the first time that I look at a S corp or a partnership tax return, just kind of try to get a flavor for it by looking at 3 different things. Usually want to look at their financials, so either QuickBooks or Wave or whatever they have, and just kind of see the bank accounts, if they're reconciled and all of that. So usually if you see somebody where in QuickBooks, it'll show you what the balance is per the bank. So if it's Chase, it'll say Chase says that the account has $5,000 in it, and then it will show you QuickBooks, and QuickBooks might show that it has $100,000 or negative $100,000 in the account. So usually when you see big discrepancies there of more than a couple $100, you know that they don't do the best job of keeping their own books, and that's almost something where they probably need some help from us, just because they're not cutting it by themselves. So that's usually item 1 I look at. And then the second items there are checking the profit against the M1 and the income statement. So basically what that is just making sure that the tax return. So over here on line 1, it says that for the prior year, their book showed a profit of $247,000. And then just a nice quick check of it, just to kind of do a diagnostic, is to look at the QuickBooks file and see that number is exactly the same. So ideally it should match up. If it's off by a couple of dollars, not a big deal, but if that says 247 and QuickBooks shows 350, that something's off. A couple of weeks ago, we were talking to a client and his QuickBooks showed a profit of like $100,000 and his tax return showed a profit of, I think, $1 million. So obviously that's something where we brought it up to the client, and what he said was that they had switched accounting systems halfway through the year. They had support for everything, and they were confident that the number was correct. But obviously, any discrepancy there, you usually know that that there's an issue. And then the third item that I usually look at is the balance sheet. I don't think there's a copy of that in here, but basically the balance sheet just shows all of the assets of the business, and then separately it shows the equity that the owner has in the business and the liabilities of the business. Biggest red flag there is that sometimes if they either do it themselves or the accountant wasn't necessarily the greatest, you'll see a balance sheet that doesn't balance. So it might show that they had, $100,000 in assets, but no liabilities. And in that situation, you usually know that there's some review that we need to do with the prior year tax return. And obviously, if it doesn't match up between the balance sheet on the tax return and the balance sheet in QuickBooks, it's just, same thing. We know that there's a problem. So yeah, so basically, if you look at line number 14 on this statement, this is a partnership, but line number 14 and line number 22 should always be the same. So if they're different, there's an issue. The balance sheet, it needs to balance. When it doesn't balance, when those two numbers don't equal out, there's a problem from the prior year. And then last two items there, it looks like basis considerations. Sometimes what you'll see is a person has a large loss on the tax return, maybe a loss of $50,000, but to get that loss, they took out a whole bunch of loans and different things. So it wasn't their own money that contributed to that loss. In that situation, we won't be able to take that loss. Scenario that I could think of recently was a client, they had been withdrawing money. Basically, they were taking out loans every year, SBA loans and different credit card loans, things like that. And they would take that money and distribute it to themselves personally. But what was happening was they didn't have basis in the business. So this is kind of an unusual one, the basis issues. But they didn't have basis in the business, and they were doing something with the prior accountant was doing something with a loan account, and it just, it was a major issue. And then they brought in their own outside business consultant, and the business consultant brought it up as an issue. We brought it up as an issue. So kind of, basis can get tricky. There's a lot to it, but definitely, we always want to make sure that they're in compliance with the basis. And when we're looking at that tax return for the first time, it's usually a good idea right by the K1, either a few pages after that or at the back of the package, you should see a basis worksheet. And, that's something we're always going to want to try to track down, just because that's important, especially now the IRS has started asking for us to provide that on the personal tax return. It used to be something where it was just kind of an internal document, but now when there's a loss, the IRS wants to see that information on the personal tax return. So, it's definitely something that we either have to try to back into if they can't give it to us, or might have to ask them if they could dig through their paperwork and try to find a basis worksheet. That's always important. And then probably this last one too is a big issue with the S corporation. It's different than a partnership in that they have two different buckets. They have their income, which is only subject to ordinary income tax, and then they have so that's the K1 income is only subject to ordinary income tax, and then they have their W-2, which is subject to ordinary income tax plus Social Security and Medicare taxes. And sometimes you'll see an S corporation where I believe it's line 7 is the owner's compensation. If that's a 0 or if that's a real low number and the profit is high, that's an issue because that's something that the IRS, they look at that very closely and they want to make sure that the owner is taking a reasonable salary, just because you look at it as if you have no W-2 income and $100,000 in K-1 income, you avoided Social Security tax on $100,000. So the IRS, that's something that they scrutinize fairly closely, and that's only an issue for S corps. Partnerships, we don't have to worry about that.
Very, very good point. And I think just in practice, what that means is, at the kind of intake side, Sean and Dylan, these are kind of things we can confirm, and there doesn't necessarily need to be an action item, right? But even just a simple question of, oh, you're an S corp. Okay. How much did you compensate yourself? And you'll hear a lot of people who start S corps or have just been kind of running it themselves because they read on a blog somewhere that you can save self-employment tax, will say, I haven't paid myself anything. And that's a point where you can say, that's interesting. Why is that? And are you aware that's something that the IRS looks at? We don't want to scare anybody, but you definitely want to say, okay, that's something we can definitely help you with and we'll advise. And certainly at the intake level, for our client help team, you get an S corp, you got to ask for you got to make sure we got the W-2s for the full business. That's just something I like to ask for, to make sure we have all of them or access to their payroll, so that we can kind of match up not just the owner comp but the total comp. So we might want to add that to our intake process as just something we ask for. And then kind of at the tax advisor level, we have to kind of think through ways as we offboard, if you will, that we basically say, hey, we did your tax return this year because the numbers are what they are. But going forward, you're going to want to see this number change because it's going to be something that may come back to us as your tax firm of record. So I know the client you're referring to, Mike, and I do think that I think we've adjusted it for it, but we might need to do kind of a mid-year check-in on that client to see where they're at payroll-wise. And the other benefit, I think, too, is if this is a client that does research and development, increasing owner comp is not just the right thing to do, but it's favorable from a tax credit perspective. That might be a specific fact pattern, but again, my goal is to kind of give you guys the tools to think through, think about where, there may be kind of questions for the reviewer, for Mike or myself, if I'm reviewing. So just with that, Mike, thanks so much for your take. I think Mike certainly looked at way more S corps and partnerships than I have in my day. So the experience shows. Thank you.
Yeah.
So in conclusion, Sean and Ashton, as we kind of realize that, as we come to understand more about partnerships, I want to make sure that we're capturing full scope when we intake. We gave you some kind of questions on prior year tax returns that, whether you're screen sharing or whether you're able to say, hey, are you able to pull up your tax return, right? You're going to get real engagement and real focus. Anytime you can direct somebody's eyes in a conversation the way we do now, studies show you're able to actually get retention where when you talk, you lose someone after like 10 seconds, right? So, and I say that and I might have lost everybody already, but nonetheless, having a visual, getting on the same page, looking at the same line item, those are things that we want you to be able to do anytime you hear, hey, I've filed this in the prior year. For onboarding, we need to update our information requests. I'll edit this out later. And then, basic issue spotting. I think a lot of the things that Mike brought up and the kind of issues in the screenshots, right? You want to make sure that there's flow, that if you do have questions, number one, ask the client. I don't think we lose anything by asking the client something when they're a new client. It's fair game. even if I think at the risk of them saying, you guys should know this, right? It's like, it's a fair question, and then elevate it to compliance and review. If you're really uncomfortable, right, you can kind of bring it up first and find out if it's a question we already know the answer to. But, most of the time it's good just to engage, to say, hey, I'm looking at your numbers. I'm not just doing data entry. I care about the numbers you've already filed, and I care about the story that your numbers tell year to year. And then finally, I think I can't say this enough. For some people, complexity has appeal. So people want the trust. They want revocable trust, irrevocable trusts. They want a series LLC that flows into a holding company, and it all sounds good. But the truth is, if you have one property, one business, most of the time, from a tax perspective, you're not really getting anything out of that except for paying us more fees. And while I think that is a thing that we like, I think we ultimately need to create value for clients by giving them a road to run fast on. And if we create too many of these, we create too much complexity. Look, eventually they're going to go somewhere else, or they're going to get a review, or, they're going to get married and they're going to have a new advisor. And this is going to come back and they're going to say, why in the world did this firm file 3 partnership returns for you? When really, you just needed a single member LLC. Maybe not a great example, but just something to think through when we take on a client. And that's something that I've noticed when reviewing returns, actually, that there's first year entities and complexity that just didn't need to be there. And I think we just need to ask the question, so it might not change, but we should always ask the question, why, like, no judgment, but why did you set this up? Because ultimately, if there needs to be a conversation, it's better to have it sooner than later. And Sean, I know you and I have talked a few situations at many clients where we've said, hey, you've set up a partnership. A single member LLC in your state is going to do the same thing for you. And it's one less tax return to file. And that fact pattern, I think, applies when you don't have a partnership return or when you don't have a property that's being, if you don't have quick deed on a property to a partnership, a single member LLC is going to be fine. Sean, did you want to say something? Or Mike, do you want to jump in? I think I heard somebody.
Yeah, that's what I was just gonna say. A lot of people, not a lot, but I have had a few leads that have said they have like a partnership LLC, even though like the revenue's like 20 grand. It's just them and their spouse. And I do ask them why, and their answer most of the time is like, I don't know, I just did it. So yeah, I mean, people don't seem to be offended when I ask that question, but I think they do kind of appreciate being asked that, because they really don't even know the answer to it. And then a lot of the times that's when we've talked and we just end up changing it to a single number.
Yeah. I mean, and again, I think the fact pattern is going to be going to drive the decision. So I don't think that's a blanket recommendation. But yeah, Mike, if I were you to, maybe this isn't quite a softball, but I mean, if you have a client that doesn't need a partnership, could easily be single member LLC, from a tax perspective, I don't really get it, but you think there's anything to kind of think about there? Obviously not talking about the legal side, but like what do you hear when you have a client says, like, I want the partnership with my wife and I, and the alternative being that one spouse is the single member. What are the considerations there? How do you think about that?
I usually try to let them know that there's really not much of a difference. Like you said, obviously it costs more money, and from a tax perspective, there's not going to be a change to the numbers. But I think a lot of people are usually proud of the fact that they own a partnership, or they have a partnership, or they have a corporation. That it's a big deal for people, and usually when they're proud of it and they're happy and they like it and they already did the legal work for it, I usually back off and let them do what they want to do. I tell them that you don't need to do it, but at that point they're proud, they're happy, they have a name and they're attached to it. So there's really no going back in a lot of situations, I almost feel.
Yeah, absolutely. So all things to kind of work through, and I think like you were saying, Sean, the question is fair, right? It's not offensive, but certainly I think if the option's there on year one, um, we can certainly always float that to them. So
Yeah,
with
sure.
Perfect. So with that, I mean, I think we've covered some kind of great little tidbits, and I think the tax pros are going to love this when we send it out. So Mike, thanks to you, big thanks to you from myself, and future thanks from Ashton coming, I'm sure.